Ever stop to think about who's really pulling the strings of the economy? It's not just one person or one group. It's actually this constant, high-stakes tug of war between two massive players: the government, the folks you vote for, and the central bank, the institution that controls the money. In this explainer, we're going to pull back the curtain on this epic power struggle.
So yeah, let's just ask it straight up. Who's really in charge of your money? Well, the answer? It's a lot more complicated and honestly, way more fascinating than you probably think. Let's dive in and find out.
All right, to really get a grip on our economy, you've got to meet its two bosses. You've got the government on one side and the central bank on the other. Now, they both have a hand on the steering wheel, but they are using completely different playbooks to get where they're going.
So here's how it all breaks down. The government handles what's called fiscal policy. Think of it as all the decisions about spending, on things like infrastructure and defense, plus setting taxes and borrowing money. Then you've got the central bank, like the Fed here in the US, and they run monetary policy. Their job, controlling the money supply, and crucially, those interest rates you always hear about. So two very different toolkits, but they're both playing in the same economic arena.
Okay, so where does money actually come from? It's not just a matter of printing piles of cash. Nope. To really understand what's happening, we've got to look under the hood of the economy and see how money is not only created, but, and this might surprise you, how it's also destroyed.
So central banks have a few pretty powerful moves up their sleeve. First, they can literally create digital money out of thin air to buy government debt, what we call bonds, that pushes new cash right into the banking system. They can also lend new funds directly to commercial banks. And then you have the big one you've probably heard of, quantitative easing, or QE. That's when they go on a massive shopping spree for bonds to really open the floodgates of money into the economy. And the key thing to remember here, almost all of this is digital. It's just numbers on a screen. Right, but here's the part almost nobody talks about. See, to keep everything balanced and to stop prices from going wild, the system also needs a way to pull money out of circulation. That's right, money isn't just created, it's also destroyed. So how does that even work? Well, there are three main ways. First, when you pay back a loan, say your mortgage or a car loan, that principal amount just poof, it's removed from the money supply. It essentially vanishes. Second, central banks can do the opposite of QE. They can sell bonds, which sucks cash out of the system. And third, if the government runs a budget surplus, meaning it collects more in taxes than it spends, that extra cash is also taken out of the private economy.
Okay, so we've met the players, we know how money gets made and unmade. So now let's get into the nitty-gritty, the actual tools they use to steer this whole economic ship. It's kind of like looking at their command console with all the levers and dials.
For the Fed in the US, this is the number that matters most: 2%. That's their target for inflation. You know, how fast prices are rising. Keeping inflation stable right around that 2% mark is their North Star. It pretty much guides every single move they make. So what's actually in the central bank's toolkit? Well, first and foremost, you have the federal funds rate. This is the big one. It's like the master interest rate that influences every other rate out there. Then, of course, there's QE, which we just covered. They can also tweak something called reserve requirements. That's just how much cash banks have to keep in the vault, which affects how much they can lend. And finally, there's a cool one called forward guidance. This is basically them just telling us what they're planning to do to help manage everyone's expectations. And what about the government's tools? Theirs are a bit more direct, you could say. They've got spending. They can pump money into infrastructure, defense, social programs, you name it. Then there's taxation. They can raise or lower taxes, not just to get revenue, but to influence our behavior. And, of course, they decide whether to run a deficit, spending more than they take in, or a surplus, which has the opposite effect. Each choice pushes or pulls the economy in a certain direction. All right, and this is where things get really interesting. What happens when these two titans, the government and the central bank, want to go in completely opposite directions? This is where you get a full-on policy war, with the entire economy caught right in the crossfire. And this quote really nails the fundamental problem they're always facing. Any policy designed to boost economic growth runs the risk of pushing up inflation. But on the flip side, any policy to fight inflation can slam the brakes on growth. It's a classic catch-22. You can't always have both. And finding that perfect balance, well, that's the whole game.
So let's play out two possible scenarios where these guys clash. First, you could have what's called fiscal dominance. This is where the government spending just runs the show. Think massive spending projects or big tax cuts. This puts huge pressure on the central bank to keep interest rates low to make all that borrowing affordable. The major risk here? Inflation could spiral out of control. Then, on the other hand, you have monetary dominance. This is when the central bank says, nope, fighting inflation is priority number one. They crank interest rates up, which makes it super expensive for the government to borrow, basically forcing them to cut back on spending. It's a real clash of the titans.
Okay, so we've talked a lot about high-level policy, governments, central banks, but what does any of this actually mean for you, for your bank account, for your day-to-day life? Let's bring this whole thing down to earth.
Let me give you a super simple example. Let's trace a policy decision all the way to your pocket. So, it starts when the Fed decides to raise interest rates here in the US, okay? That one move kicks off a whole chain reaction, and that leads to a stronger US dollar. Why? Because higher interest rates are like a magnet for global investment. People and institutions all over the world want those better returns, so they have to buy US dollars to invest here. More demand for the dollar means its value goes up, which then means your European vacation just got cheaper. Seriously, with a stronger dollar, your money suddenly has more buying power overseas. So that trip to Italy or Spain you've been dreaming about, the cost of hotels, food, everything just went down for you. See? A huge policy decision right in your travel budget.
And this is how it all comes together to shape your financial reality. Think about it. High interest rates are great for your savings account, but they make your mortgage and car loan more expensive. Inflation eats away at the value of the cash in your wallet, but it can actually boost the price of assets like your home. Exchange rates, capital flows, all of this stuff isn't just abstract economics. It trickles down and directly impacts your life every single day. So you see, this constant tug of war between government spending and central bank control isn't just some dusty economic theory. It directly shapes your financial world. And yeah, the system is complex for sure, but hopefully now it's not such a mystery. So the real question isn't just who's in charge anymore. The new question is, now that you understand these powerful forces, what are you going to do about it?